Okay, shall we start?
Yeah, I think we can start.
Okay. Hello, everyone. Thank you very much for joining this workshop. So first of all, I would like to thank the organizer, Wuhan University Climate Change and Energy Economics Study Center, especially Professor Tan for inviting me for organizing this workshop. My name is Farhad Taghizadeh-Hesary from Tokai University. I'm an associate professor of economics at Tokai University in Japan. And so my main area is energy economics, energy policy, energy finance, green finance. And today I'm going to have I'm going to have three lectures on topics related to energy and environment. So let me share the screen with the first presentation. So as it is clear here.
Sorry, I cannot see the screen, the content on screen. Oh, okay.
Yeah, it is clear now. So the topic of the first presentation is on green credit guarantee scheme. So I will introduce credit guarantee system, green credit guarantee, and how to adopt an optimal credit guarantee system. So this is outline of my first presentation, introduction, challenges for green development, green credit guarantee scheme. Then I will talk about an optimal credit guarantee scheme. Then empirical study, I will present the empirical part. So unfortunately, the most disappointing aspect of the contemporary global economy is the low rate of investment in sustainable projects. So the low rate of investment in sustainable project is mainly due to lack of long-term financing, existence of various risks with green projects, lower rate of return of green projects, and lack of capacity in the market actors. So although everyone, in the policy makers level, in the communities level, in the companies level, firm level, we all know the importance of energy transition and shifting from burning fossil fuels to renewable energy. But unfortunately, still we are far behind the goals that's set by the United Nations, which is so-called Sustainable Development Goals and Paris Agreement on Climate Change and COP26, the latest one. So it means huge investment gap is existing. And because of these four main reasons that I have mentioned, we couldn't achieve to the goals yet. So any solution that can solve these issues is possible to bring the private investment into green projects. So in order to show the magnitude of the investment requirement, I brought this figure. So the left-hand side, the pie chart is showing that the major parts of the infrastructure investment requirement in Asia and Pacific is for power sector, and secondly for the transportation sector. Of the estimated total climate adjusted investment requirement for 2016 until 2030, about 14.7 trillion US dollar is for power and 8.4 trillion is for transportation sector. So among different Asian subregions, the largest demand, the largest investment gap is in East Asia. and East Asia almost requires about 16,000 billion US dollar, or more than, this amount, climate adjusted amount for up to this period. And the second large share is for South Asia, then Southeast Asia, Central Asia, and Pacific. But before I go and focus on the topic of the today's lecture, which is the credit guarantee scheme, let's talk a little bit and let me highlight that why these challenges are existing. The first reason behind the existence of this challenge is a lack of long-term financing. As it is clear in this figure, Asian financial systems are dominated by banks in China, in India, in Indonesia, in Philippines, in other Asian countries. Majority of the financial system is dominated by banks. Share of pension funds, share of insurance companies, share of mutual funds is tiny when comparing to bank resources and comparing to bank loans and deposits. Bank loans are mainly coming from deposits. Deposits are mainly short to medium term. On the other hand, infrastructural projects are long-term projects. If we allocate short to medium-term projects to long-term projects, in finance, we call it a problem which is maturity mismatch. So bank resources are not very suitable for funding infrastructural projects. Therefore, for funding or for financing infrastructural projects, including green infrastructural projects, we need to have long-term money, 10 years money, 20 years money. Then pension funds and insurance companies are suitable because they are holding long-term money. They are holding 10 years money, 20 years money, 30 years money. The second challenge which is existing is existence of various risks associated with low carbon sector. Still, many technologies in the green sector are new and they are in the earlier stage of development comparing to fossil fuel technologies that many of them back to more than 100 years ago. So technology risk is existing and technology is a matter. Then feasibility risk. Feasibility is also a matter because technologies are expensive, so rate of return or the profit of the projects would be low, so feasibility is an issue. Exchange rate risk is existing because production of many green infrastructure, green product is coming from a global or at least a regional supply chain. Countries are relying on each other and they need to import, export. So because of that, exchange rate risk is matter. On the other hand, many countries for financing their infrastructural projects, they are relying on overseas money. That will creating a burden for the country, which is a debt. And also exchange rate, because many of these finances, foreign finances are in foreign currencies that will create a burden, debts, and also the exchange rate. There are also many other conventional risks such as political risk, operational risk, disaster risk, if a wind power generator damaged by wind, by a hurricane, or a solar power panels damaged due to a natural disaster. These are other types of conventional risk. The third reason behind the lack of development of the green sector that we couldn't achieve the target is the low rate of return of these projects. Actually, if governments, if policymakers wants to take right policy, especially in the green sector, they need to consider, they need to put themselves in the place of investors and see everything from the investor's view. From the investor's view, only two things is important, basically, rate of return and risk. So if we want to adopt any policy that be effective for filling this green finance gap, we need to increase the rate of return, or the policy needs to help to increase the rate of return of the project and reduce the risk. Then it would be helpful. And then private sector will enter more into this sector. So many of the green technologies are often earlier in their development stages and not always commercially viable, comparing to the technologies in the fossil fuel field that many of them back to almost 100 years ago. So because of that, they are expensive and riskier ventures. So according to an OECD study, there are more than 800 different policies globally for supporting fossil fuel projects. So this is making an unfair competition between fossil fuels and green sector. Another type of subsidy, which is an indirect one, takes place when fossil fuel companies are not taxed efficiently. So inefficient tax system and inefficient carbon tax system is also one of the reasons that fossil fuel sectors could grow much more than green sector. The fourth challenge behind this lack of development is lack of capacity in the market actors. Investment in low carbon projects are also undermined because of lack of familiarity, limited information and knowledge, limited expertise on green infrastructure among investors. For example, according to a study done by OECD, just among OECD member countries, about $50 billion investment is required just for the capacity building, just for increasing the knowledge of the market actors. So since I'm a researcher, I'm working in this area, I see that difficulties in accessing to data, green data is scarce and is a matter. And till we don't have a good data and a good database, green database in our countries, then we cannot run a practical research that be helpful for the society and also show the way, show the right way to the policymakers. So lack of transparent information, data, and financial research in this area is also another obstacle. Okay, so up to now, I talked about the obstacles and challenges behind the development of green sector, green infrastructure. And now, from now on, I want to focus on green credit guarantee scheme. That what is the green credit guarantee scheme? First of all, what is credit guarantee scheme? Then what is green credit guarantee scheme? What are the ways for developing this scheme, this system? What is optimal credit guarantee scheme? How to achieve it? So credit guarantee corporations are public entities which are available in different countries, in Japan, in China, in Korea, Indonesia, Philippines, European countries. They have credit guarantee corporations. Credit guarantee corporations are mainly active for filling the finance gap of small and medium-sized enterprises, and mainly specialized for SME. So this is a book that I edited, Unlocking SME Finance in Asia, Role of Credit Rating and Credit Guarantee Scheme. I edited it jointly with Professor Naoyuki Yoshino. It was a project for OECD and Asian Development Bank Institute. So the history of credit guarantee corporations back to 1937, that the first credit guarantee corporation started from Japan. Then from Japan, Credit Guarantee Corporation spread to Europe, Americas, Africa, Asia, Oceania, and to other parts of the world. So CGC, or Credit Guarantee Corporations, as I have mentioned, are public entity. In Japan, there is one Credit Guarantee Corporation in each province, one in Tokyo, one in Hokkaido, one in, Hiroshima, and in each province. And also 4 in these 4 cities, Nagoya, Yokohama, Kawasaki, Gifu. So why each province has its own credit guarantee corporation? Why each province has its own credit guarantee corporation? Because in order to have equal development throughout the country, it is very important to have equal funding and equal financing. In many countries, financing is relying on center, on capital. So that will distort the development. Center will grow more than other places. China is also a very good example. So Chinese provinces are also not relying on Beijing for their financing. So provinces, prefectures are collecting taxes domestically, and also they have their local funding channels. So because of that, in China also, development, it used to be unequal, but now it's going to be equal, and different parts of China are growing. So as I've mentioned, credit guarantee corporations are mainly targeting and mainly benefiting small and medium-sized enterprises, SMEs. And Japan has almost more than 4 million SMEs. From these 4 million SMEs, almost near to 40% of them already use this service and already received guarantee from credit guarantee corporations. But how does it work? So credit guarantee corporations, as I've mentioned, are public entities. Their capital is coming from the government, and they are providing guarantee. For example, 70%, 80%, 90% of the lending to SMEs up to a ceiling is guaranteed by CGC. Before establishment of credit guarantee corporations, in many countries, SMEs had difficulties for accessing finance. Still, SMEs have lots of difficulties. When an SME approach to bank, because the bank cannot assess the risk because of asymmetry of information, because of lack of audited books, financial statements. So bank ask for collateral, for example, real estate, property as a collateral. In majority of the cases, SMEs do not afford to provide such collateral. Then bank refuse to lend to that SME. The loan application is rejected. Then this is when the credit guarantee corporations comes into this middle. SME approach to credit guarantee corporation, and then all information, all risk would be assessed. In some cases also, bank send the document of the SME to credit guarantee corporation. Then credit guarantee corporation, if found out that this SME is healthy, is low risk, would have higher chance of success, would provide guarantee. 70%, 80%, 90% guarantee. Then banks that find out that the major part of this risk is covered by the government would show interest to lend to this SME. So in Japan, there is partial guarantee system. It means 80% of the lending to SMEs is guaranteed by government. In some cases, government is increasing this guarantee ratio. For example, during COVID-19, because many SMEs suffered, and many SMEs, because of the recession, because of low demand and low disruption in the supply chain, they found problem and they couldn't have enough revenue or make sufficient profit. So they lost a lot. So government increased the guarantee ratio to 100%. So it means occasionally, if a disaster happened, for example, during the great earthquake, the Fukushima nuclear disaster and great earthquake, in that region, many SMEs suffered and they lost their business. So government provided maximum guarantee for that region for a certain period until their businesses recover and they could get rid of that situation. But what is the funding of Credit Guarantee Corporation, these 51 CGCs which are existing in Japan? So a portion of their budget is coming from local governments, but the main budget is coming from the central government, from Ministry of Finance, Ministry of Economy, Trade and Industry. They are providing the funding. And these 51 guarantees credit guarantee corporation, which are one in each province. They are providing guarantee to financial institutions, to banks, and then banks give loan, provide loan to small and medium-sized enterprises or micro enterprises, and SMEs pay back these loans. And also a guarantee consignment contract also needs to be finalized between CGCs and SMEs. Okay, up to here, I talked about credit guarantee corporation, but maybe you asked that what is the relationship of it to green sector, renewable energy sector. So what I and my co-authors propose is that credit guarantee corporations are entities which are already existing in many countries. So it is possible to use a similar scheme and expanding it to the green sector, or it's possible to establish new entities. It's called green credit guarantee corporations, specialized for the green sector. Because green projects are also so much similar to, from the financing perspective, so much similar to SMEs. Many of the green projects are considering as a risky project from the point of view of financial institution. Many of the owners of green projects are not able to provide collateral to banks for covering their risk. However, these projects are important, similar to SMEs, which are important. So it is important to keep them survive, to keep them alive. So here is the scheme of credit guarantee that I've mentioned. Green project owners approach to financial institutions, but because of asymmetry of information, because of lack of collateral, financial institutions refuse to lend them. Then the green project approach to Green Credit Guarantee Corporation, which is a public entity. Green Credit Guarantee Corporations check the credit worthiness of the project. And then if found out that this project is suitable, this project will have a higher chance of success, and the owner of it or the investor of it has enough knowledge, enough information, enough expertise for running this project, then provide guarantee, for example, 70%, 80% guarantee, and then signing an agreement, guarantee agreement. Then the green project owner needs to pay some fee to the Green Credit Guarantee Corporation. It's called credit guarantee fee. And after that, this guarantee agreement is established. Then similar agreement is finalizing between Credit Guarantee Corporation and financial institution. Then financial institution will lend to green project owner, and green project owner will pay the installment, interest payment to the financial institution. So I believe through establishment of this scheme, it's possible to use it. So I'm glad that we worked on this area, and 2 years ago I proposed this scheme. I proposed Credit Guarantee Corporation, Green Credit Guarantee Corporation. At that time, no one talked about it, but I'm glad that yesterday I was presenting this idea for APEC conference that organized by Tianjin University. And during that conference, specialists from AIIB, which is in Beijing, Asia Infrastructure Investment Bank, mentioned that Asian Infrastructure Investment Bank already started green credit guarantee. And they also read our works, our research, our paper. So I'm glad to hear that these kinds of research that we have done could be beneficial, and international organizations also use this idea and started to run it. So this is, for example, the first paper that I mentioned, Green Credit Guarantee Corporation, in it about 2 years ago. And the theoretical background of it, the mechanism of it, completely described in it, that how establishment of this scheme would reduce the asymmetry of information, would increase the funding to green projects and will increase the willingness of the private sector to fund this project. So green credit guarantee is working as this figure. Presently, the loan supply curve to green projects is backward bending. It means the interest rate increase at higher lending amounts. Then the lending amounts cannot grow and just the interest rate increase. But by establishment of this scheme, the loan supply curve will shift to right. And then the interest rate will reduce. When the interest rate or our green interest rate, a lending rate to green projects reduce, then this means that the cost of capital will be reduced. Then investors can borrow from bank at cheaper interest rate that will increase the rate of return of the project. Initially, in the beginning of my presentation, I mentioned that one of the main challenges behind the development of green project is low rate of return. So when the interest rate or cost of capital reduce, the return of the project will increase. And establishment of green credit guarantee corporation also can cover the credit risk. Credit risk is one of the major risks for these kinds of capital investments. But two critical questions need to be answered for developing an optimal credit guarantee scheme. Maybe you ask, what is the optimal credit guarantee scheme? What is the optimal green credit guarantee scheme? So when we are talking about government support, that governments need to support the green sector, governments need to support the green sector, and the green sector needs to be developed more and more. Many people just mentioned that governments need to provide subsidy, or governments needs to just get taxes from the polluting industries and pay to the greener industries. But paying subsidy, maybe in the word it is easy, but in practice it is very difficult because governments have lots of fiscal issues. Governments have different fiscal issues, different burden, especially during the COVID-19 with the huge expenditures that governments are providing for the healthcare system, for transfer payment, for supporting vulnerable sectors. So it means the burden increased a lot, and maybe it's not possible to pay additionally for the green sector. So this means that when we are looking for a solution, the solution needs to be financially sustainable. The solution shouldn't rely so much on government's money. Maybe governments only need to bring the seed money, the initial capital. Then the system, the scheme needs to run by its own earnings, by its own revenues, and not relying on government money. Then this would be financially sustainable. On the other hand, if the system can help and solve and fill the green finance gap, then all in all, we call this system optimal credit guarantee system. So optimal credit guarantee scheme is a scheme which is not so much relying on government money. On the other hand, this system is able to solve the green finance shortage and solve it and fill this finance gap. So in order to achieve, in order to reach to the optimal credit guarantee system, we need to answer to these questions. We need to consider these two questions. What is the optimal credit guarantee fee to be paid by green project? The fee that project owners need to pay to the credit guarantee corporations, because very expensive fees will create another burden for the project owner. I've mentioned that investors in the green sector, they already have lots of problems. Rate of return is low, risk is high. So if government also wants to create another burden for them by charging a high fee, so it means that this is another obstacle. This is an additional obstacle that will create a problem. The second question, or the point that need to be considered, is that should credit guarantee corporation provide same guarantee ratio to all lending institution, or should it be different based on the healthiness of the lending institutions? Because ultimately the lending institutions or banks are benefiting from this system, because they're lending to the SME, they're lending to the green project is guaranteed by the government, so they can feel free and lend up to a certain ceiling. But should government or credit guarantee corporation provide same guarantee ratio to all banks? For example, 80% of the lending of banks to green sector be guaranteed by the government, or 70% or 80% for all banks, or whether the government or the credit guarantee corporation needs to differentiate it and needs to categorize the banks based on their healthiness. If governments adopt same guarantee ratio for all banks, then it would be moral hazard, because all banks are not same. Some banks are healthier, some banks are riskier, some banks are accumulating non-performing loans. So it means not all banks should be considered as same banks, and maybe adopting the same guarantee ratio to all banks is not optimal. So this figure is illustrated. This figure illustrated what I have mentioned in the previous slides. In order to have an optimal credit guarantee scheme, both sides of this story needs to be considered. In the left-hand side, we have borrower or the project owners. For example, low carbon 1, low carbon 2, or green project 1, green project 2. On the right-hand side is the lenders. So project owners or low carbon projects are seeking guarantee, because using that guarantee, they want to borrow from banks. But the fee that they need to be paid, they need to pay should be optimal. It means adopting guarantee fee based on the macroeconomic situation, first of all. When we are in a recession, when we are in a tough macroeconomic situation, like the current situation, the fee needs to be reduced so that the project owners have less burden, and they can run their project easier. So it means the fee needs to be dynamic. The fee needs to be function of macroeconomic situation. Secondly, the fee needs to be based on the risk of the borrower. If the borrower has very low risk, so the fee needs to be lower. If the borrower has a higher risk, the fee needs to be higher. So the fee needs to be function of the risk of the borrower also. So then adopting same fee level to all projects, regardless of the risk of the project, would also create a moral hazard. Then in the bank side, because banks are ultimately benefiting from this system, what is the optimal guarantee ratio? 80%, 85%? This needs to be calculated by a method. So when I'm presenting credit guarantee scheme for many government officials, I presented for many countries, for their governments, I ask them, what is the optimal, what is the current level of guarantee ratio in your country? For example, they answer 80%. They answer 85%. Then I ask them, how did you calculate this 85%? Why not 90%? Many of them, they cannot answer because they don't have a model for calculating this guarantee ratio. And they just picked this, maybe looking at other countries. So it needs to be a model behind it, and it needs to be a ration behind it. Optimal credit guarantee ratio. Second question is that should Credit Guarantee Corporation provide same guarantee ratio to all lending institutions? The answer is no. It would be moral hazard. So if Bank A is more sound, if Bank A has higher level of credit worthiness, then Bank A needs to receive higher guarantee ratio. If Bank B is riskier, then Bank B needs to receive lower guarantee ratio. Then it would be an incentive for Bank B to enhance the credit worthiness to become a sound bank in order to receive higher guarantee ratio. The second, the other question in this side is that whether this guarantee ratio should be constant throughout the year, regardless of the business cycles, or whether this ratio also need to be function of a business cycle. When we are in a recession, the guarantee ratio needs to be increased so that banks lend to these projects easier. And when we pass it, when we are in a boom, then guarantee ratio reduced. So this means that guarantee ratio is also a dynamic variable and it is not fixed constant. So this needs to be attention. So if you are interested to read more about the guarantee system, especially how to measure the credit guarantee fee, how to measure the credit guarantee ratio. For example, you can run this research for China. I haven't seen any study that measured the level of optimal credit guarantee fee, for example, for Chinese firms, for Chinese green projects, or you can run it for your local, for your own province. This paper is showing the model for calculating the optimal credit guarantee fee, and this paper is showing the model for calculating the optimal credit guarantee ratio. Briefly, very briefly, if I want to explain about it, so we have a policy objective function, we have the loan demand function, we consider the bank side as well. And this is the ultimate, the final equation that we have for the optimal credit guarantee ratio. It means how many percent of the bank's lending to SMEs should be guaranteed. So as it is clear here, the credit guarantee ratio is a function of many variables: actual green loan, the desired green loan. But if I want to categorize it, it is a function of three different groups of variables: macroeconomic variables, secondly, government policies. What is the government policy? Whether government wants to promote the green sector or government doesn't have any plan for doing this. And number three is the soundness of banks. So that is also very important. Next part of this presentation is the empirical study. So using data from one Asian country, we measure the guarantee ratio, the optimal credit guarantee ratio. This is available, this research is available in these two papers, especially if you want to read the guarantee ratio in this paper, it is available, the empirical part. So for this study, we collected the data, bank level data, and also project level data. More than 1,300 projects data were collected, and all banks of one country, one Asian country, the data is gathered. And we collected the financial statements data of the banks. And different variables were introduced. For example, total loan to total deposit, properties to total loan, saving deposit plus long-term deposit over total deposit, and so on. But who can say that, for example, what is the indicator that shows the credit worthiness of the banks? Although many scholars just look at the non-performing loans ratio, but that is not enough. We need to look at assets. We need to look at amount of deposit. We need to look at the capital. So different kinds of variables needs to be considered. So because of that, we use principal component analysis in order to using all these ratios and then making components, 3 components out of these variables, indicators. So these 3 components are including the information of all these indicators. So then we plot it. Z1 is component 1, Z2 is component 2. Each of these dots are 1 banks. As we see, some banks are outliers. So it means maybe this group of banks have more similarity. This group of banks have more similarity. This group of banks have more similarity. Then when we plot by other components, Z2, Z3, Z3, Z1, we see that again, almost similar banks are outliers here. Then we use another method, clustering, which is also, the notion behind the clustering and the principal component analysis, both of them are dimension reduction. So principal component analysis is eliminating the correlation, because when we are looking at these indicators, there is very high correlation and there is possibility of multicollinearity if we want to use these variables in our regression. For example, many of them, for example, these 2 variables have loan inside. These 2 variables have deposit inside. So there is possibility of very high correlation. But principal component analysis eliminate the correlation, redundant information, and run the dimension reduction. Then by using those components that we got from principal component analysis and then running these clustering, we could be able to group the banks into 2 groups. Group 1, F1, M, K, L, Z, and these are group 2. And then we use the data, we use the model, the theoretical model that I have showed you, and we use the data that we got, real data of macroeconomic data, policy data, and bank level data. Bank level data are coming from this Z1, Z2, Z3 that we did. And we measured the optimal credit guarantee ratio for group 1 banks and for group 2 banks. As it is clear here, government, in order to develop an optimal credit guarantee system, we propose that the guarantee ratio for group 1 banks be about 0.775, and for group 2 banks, which is riskier group, be about 0.683. And as I've mentioned here, the determinants of the optimal credit guarantee ratio for both groups of banks is categorized into 3 groups of variables: macroeconomic variables, government policy, and banking profile. These are the macroeconomic variable, these are the government policy and banking profile. For the robustness check, we also ran a vector error correction model because of existence of co-integration. The left-hand side of this regression that we have done in the impulse response function is NPL over L. NPL means non-performing loan over total loan. This is one of the most common indicators of the soundness. So we want to see the response of non-performing loan over loan for each groups of banks to impulses that we give to macroeconomic variables, government policy, bank profile variables. This is the response of group 1 banks, which is healthier group, and this is response of group 2 banks. As it is clear here, both groups of banks, their NPL over L shows similar response to impulses that we gave to macroeconomic variable. This is the accumulated response of NPL over L to M1, this is to CPI, consumer price index, this is to GDP. And for the second group is also same. It is positive, this is also positive, this is positive, this is, this is negative, this is also negative up to here, then after that became a little bit insignificant. And also to GDP, it is negative. To GDP as it is small, but it is negative up to here. After that, it becomes insignificant. The point is that both of these groups of banks are showing similar response to macroeconomic shocks, but they are showing different responses to idiosyncratic shocks, to the shocks that we gave to the bank level. You see that, for example, this is what we gave to Z1 and bank 1 Z2. This is bank 2 Z2. As you see here, this is positive, but this is negative. So it means these two groups of banks are showing different responses to bank level variable. So this is another reason that banks needs to be categorized. And when, for example, Chinese government wants to adopt a guarantee system for the green sector domestically, then government needs to categorize commercial banks and private banks, categorize based on their soundness. If a group of banks is healthy, government provide higher guarantee ratio for lending to green sector, for green loan, and lower guarantee ratio for lending to the green loans. So this is a finding that we had in this paper, and these are the references, Handbook of Green Finance, and so on. So thank you very much for your attention. So this was the first presentation. If you have any question, please let me know.